Cash and cash equivalents are financial assets that are either cash or instantly convertible to a known amount of cash. Cash is exactly that, money in hand, but it also refers to money in a savings, checkings or brokerage account where it may earn a return or interest. Cash equivalents are secure, ultra-short-term and practically risk-free cash or debt instruments that return a fixed or variable interest. That means their issuers have high credit ratings, their durations are less than a year, and they usually guarantee the principal or deposit. The interest cash and cash equivalents return depends on the prevailing inflation and interest rates. The higher those are, the higher the interest cash equivalents will pay. Moreover, cash and cash equivalents are low risk and low return assets, but only when inflation is not rising. When inflation rises, they lose value or purchasing power as they are worth increasingly fewer goods and services. That said, their value is fairly stable, and they are a great vehicle to carry your emergency fund or money you need for upcoming expenses, like saving for a wedding in a few months. Cash equivalents include treasury bills or T-bills, high-interest savings accounts or ISAs, ultra-short-term cashable or redeemable guaranteed investment certificates or GICs in Canada, ultra-short-term cashable or redeemable certificates of deposit or CDs in the US, money market funds or MMFs, and cash exchange traded funds or ETFs. Now let's take a closer look at each of these. Treasury bills or T-bills are ultra-short-term zero-coupon government debt that the public buys at a discount directly from the government or from financial institutions. The issuing government guarantees the buyer's principal and interest with the full faith and credit of the government and its taxation powers. The interest is the discount on the T-bill's face value that the government offers you to borrow it money, and at maturity, the government pays you the T-bill's face value. For instance, you pay $95 for a $100 T-bill after a 5% discount, and you get $100 back when it matures. That nets you a 5.26% effective interest rate on your $95 investment. The charts you see here show that the US and Canadian governments are currently offering about 5% discount on T-bills. Moreover, unlike all the other cash equivalents we'll look at, the interest from T-bills are only subject to federal tax, not state or provincial taxes. High-interest savings accounts or ISAs are savings accounts with interest rates much higher than regular savings accounts and are offered by banks or discount brokerages to their depositors. In Canada, ISA deposits are usually guaranteed by the Canada Deposit Insurance Corporation or CDIC up to $100,000. Meanwhile, in the United States, the Federal Deposit Insurance Corporation or FDIC does the same but insures up to $250,000 of deposits. Being savings accounts, ISAs don't have meaningful fees linked with owning them, but like most bank accounts, they normally have a small account maintenance fee. This graphic shows the top 3 highest ISA rates currently offered by financial institutions in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can say that it's probably better to invest in T-bills over ISAs in Canada and ISAs over T-bills in the US. Guaranteed Investment Certificates or GICs are Canadian fixed or floating interest rate term deposits. For GICs to be cash equivalents, they have to be ultra-short-term, cashable or redeemable type and have fixed interest rates. Ultra-short-term means the GIC's duration is 1 year or less. Cashable means the GIC allows early withdrawals at any time without penalties. Redeemable means the GIC allows but penalizes early withdrawals and only allows them after a holding period. GICs are offered to depositors by Canadian banks, trust companies and brokerages, and their principals or deposits are usually guaranteed by the Canada Deposit Insurance Corporation or CDIC or other provincial deposit insurance programs. Certificates of deposit or CDs are the US version of GICs. They are issued by banks, credit unions or brokerages to depositors in the United States. Moreover, their principals or deposits are normally insured by the Federal Deposit Insurance Corporation or FDIC. GICs and CDs do not have any fees linked with owning them, not even the small account maintenance fee that ISAs usually have. This graphic shows the top 3 highest GIC and CD rates currently offered by financial institutions in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's probably better to invest in T-bills over GICs in Canada and CDs over T-bills in the United States. Money market funds are mutual or exchange-traded funds or ETFs, having at least 95% of their holdings in other cash equivalents with average duration less than a year. They are offered by mutual fund firms, banks, wealth managers, and brokerages, and function like savings accounts. But unlike savings accounts, their returns fluctuate daily, and their principals are not CDIC or FDIC insured. Aside from their uninsured principals and variable yields, their returns are also impacted by their management expense ratios and fees. Although this is more of an issue in Canada, where these fees are much higher than in the US. This graphic shows the top 3 highest money market fund rates currently offered by financial institutions in Canada and in the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's a toss-up between investing in T-bills or money market funds, both in Canada and in the US. Cash exchange traded funds or cash ETFs are ETFs whose daily traded shares represents its investors' pooled capital that the fund manager deposits in high interest savings accounts at major financial firms, usually at higher negotiated interest rate than individual depositors can get with regular ISAs. Cash ETFs are offered by mutual fund firms, banks, wealth managers, and brokerages, and their shares are traded daily on stock exchanges. Unlike money market funds, they return variable yields or dividends and do not guarantee their investors' principal, unlike T-bills and most ISAs, GICs, or CDs. Aside from their uninsured principals and variable yields, their returns are also impacted by various costs like stock exchange fees, brokerage trading commissions, and fund management fees. This graphic shows the top 3 highest cash ETF yields currently offered in Canada and the United States. Comparing this to the T-bills discount charts we saw earlier, you can see that it's probably better to invest in cash ETFs over T-bills both in Canada and the United States. Right, that does it for cash and cash equivalents. Next, we'll delve into the real estate asset class.